CVC Credit Partners European Opportunities is a closed-end investment fund which is investing through a Luxembourg vehicle, CVC European Credit Opportunities. It aims at providing investors with recurring income and capital appreciation through a portfolio which is diversified and focused on levered credit. Its portfolio is divided into two pools. One is the performing credit part, where CVC acquires assets close to the par value and with the intention to generate recurring income from coupon payments. And the other pool is consists of credit opportunities, which are assets usually traded below par with revaluation potential. The company aims to generate a gross return of 8 to 12% per annum, whereby the performing credit part should generate around 4 to 7% per annum, while the credit opportunities part should provide a return of around 7 to 20%. The current income should represent around 5% return per annum. The investment vehicle primarily invests in assets which are senior in the issuer's capital structure, including first lien loans as well as senior secured bonds, which jointly represented around 80% of the portfolio as at the end of August 2019. The portfolio is also skewed to floating rate assets, which represented around 86% of the portfolio at the end of August, and issuers from Western Europe. The investment vehicle has an actively managed portfolio of sub-investment grade debt assets with an annual turnover of around 100%. What is also important, the investment vehicle is also trading within the debt structure of the issuer, which means that it can acquire assets with different maturities, currencies, and seniority. The company's investment manager, CVC Credit Partners, is well positioned with this respect based on a large experienced team, an extensive database of potential investments, and an in-depth fundamental approach. Capital requirements for banks remain strict, which encourages them to sell loans off their balance sheets, and as a result, it triggers the further shift in the global leveraged loan market from banks to institutional investors. We believe this is a long-term market opportunity for CVC Credit Partners European Opportunities. While we are entering a phase of economic slowdown, the credit fundamentals globally remain solid, with the ongoing monetary easing assisting low default rates, while new issuance is being supported by high corporate activity to fund growth and M&A. We understand that a high proportion of covenant-light debt will at some stage in the longer term result in lower recovery rates once default rates start to increase. However, the loose covenants coupled with relatively distant maturity dates mean that this is unlikely to happen in the short term. The delayed monetary tightening has resulted in capital moving from floating rate assets to fixed rate assets. This, in conjunction with the ongoing macroeconomic and political uncertainties associated with the US-China trade war, as well as Brexit, have negatively impacted CVC Credit Partner European Opportunities portfolio in the short term, given its high exposure to floating rate assets. Having said that, the company has also benefited from the rally in fixed rate high yield bonds, realizing the positions which rate the most. Within its credit opportunities portfolio, it is working through a number of assets restructuring and positioning processes, which is aimed at driving performance towards the end of the year. The company's year-to-date performance as the end of August 2019 stands at 0.5% in euro terms and 1.4% in sterling terms. Having said that, over the last 5 years, the company was able to deliver an NAV total return of around 5.3% per annum. The company is being charged a management fee of 1% per annum of NAV, and it also may be charged a performance fee of 15% of excess returns in case total returns exceed 5%. This is subject to a high watermark and is already reflected in the NAV performance of the investment vehicle. The company aims to pay a dividend of 5.5 pence, which translates into a dividend yield of around 5.5%. The company has certain conversion facilities in place which minimize the discount to NAV, which recently stood at low to mid single digits levels.